Holy shit, the FOMC minutes were just released and the Fed and the markets are in massive disagreement. So we have a lot to talk about. It could mark more downside, but let me know down below in the comment section. The most important thing, I don't care if you like the video or subscribe to the channel, but make sure to comment down below. What is your thought? What is your opinion on the FOMC minutes? Could this mark the beginning of new lows, or could this be an opportunity to get a bounce at least until later in the month of July? So let's get straight into this video, guys. FOMC minutes. What are we waiting for? The Fed sees more restrictive policy as likely if inflation fails to come down, the minutes say. Federal Reserve officials in June emphasized the need to fight inflation, even if it meant slowing an economy that already appears on the brink of a recession, according to minutes released Wednesday. If raising benchmark interest rates by 0.75 percentage point, central bankers said the move was necessary to control cost of living increases running at their highest levels since 1981. Members said the July meeting likely would see another 50 or 75 basis point move. And just so you guys know, a basis point is 1/100th of 1 percentage point. So 50 basis points, this is just, if you guys don't know, is 0.5%. Just add a 0 point, your basis points, and there you have it. Quote, participants concurred that the economic outlook warranted moving to a restrictive stance of policy, and they recognized the possibility that an even more restrictive stance could be appropriate if elevated inflation pressures were to persist, the document said. And that is going to be key, and we're going to talk about that more in just 1 second. But they also acknowledged that policy tightening would likely come with a price. Quote, participants recognized that policy firming could slow the pace of economic growth for a time, but they saw the return of inflation to 2% as critical to achieving maximum employment on a sustained basis, the meeting summary stated. It says the move to hike rates by 75 basis points followed an unusual sequence in which policymakers appear to have a last-minute change of heart after saying for weeks that a 50 basis point move was almost certain. The Fed's resolve officials at the June 14th to 15th meeting remarked that they need to make the move to assure markets and the public that they are serious about fighting inflation. Quote, many participants judged that a significant risk now facing the committee was that elevated inflation could become entrenched if the public began to question the resolve of the committee to adjust the stance of policy as warranted. Now, why is this so bad for markets? Well, the markets are basically telling the Fed that you cannot raise as aggressively as you want to because the economic outlook is not good. We can see after the last CPI report that came out on June 11th, the 10-year bond yields just rallied from there. It was a parabolic move at the same time the stock market was hitting lower lows like you would expect to see. Well, the US 10-year Treasury at the peak hit almost 3.5%, which was pricing in more tightening, right? The higher this goes, the tighter economic conditions are, the more expensive it is to buy a house, to buy a car, get lines of credit, to do any kind of lending or borrowing. It really revolves off the 10-year Treasury, right? Well, when the Fed is outlining a plan to raise rates as aggressively as they are, you should not see the 10-year Treasury yield falling as much as it has, around 60 basis points from just mid-June. So not too long ago, the rates were a lot higher, 3.5%, like I just said. Now, the bond yields have been falling because people are scared about a recession. Investors are buying bonds because, hey, if you're fearful of a recession and deflation at that point, well, a 3% yielding bond doesn't sound all too bad. So we've established that. Bond yields should not be coming down, which they have been over the last couple of weeks. Well, now, if the Fed is continuing to push for 50 basis points, 75 basis points, and they say, hey, we're not going to stop. We might even go more aggressively, which they just indicated during the minutes, which I just showed you guys. Well, that means the US 10-year Treasury yield has to go up a lot more from here in a very substantial way. So it could happen quick, it could happen slow, but the US 10-year Treasury yield either is going to go up in a big way, and that's going to send markets down in a very big way, or the Fed will have to U-turn and they will have to listen to the bond market. They will have to say, yeah, we're just going to slow down. We're not going to go as aggressively. But from the perspective we're sitting at right now, the bond market is not pricing in a potential rate cut until at least halfway through 2023. So we're expecting a lot more tightening. We're actually expecting interest rates to be 3.5% by the end of this year. That would be another 2% of rate hike increases. And if you're expecting 3.5% here over the course of the next, 5 months or so, 4 or 5 months or so, well, the bond yields have to go up at least another 1% at the very minimum, 3.9%, 4% at the very minimum if the federal funds rate is sitting at 3.5%. So you're going to see either bond yields shoot up in a big way, or you're going to see this recession come by the end of July. Bond yields would come down, but then at the same time, when you go into recession and people are fearful about the Fed, of inflation, of all of these other macroeconomic factors that are going on and micro economic factors, well, stocks would also go down. So it's kind of like a lose-lose kind of scenario right here. I think it could be more bullish if we do head into recession because the 10-year treasury would continue to fall, and then I think the Fed would end up slowing down as they do see inflation hopefully starting to come down during this next report. We're expected to get 8.8% year-over-year inflation for this next report, so it's not priced in that we have seen the peak of inflation just yet. But maybe by the end of July, you could get that flush out event and you could see a move back to the upside. But the bond market is definitely disagreeing with the Fed in a massive way. We have not seen the bond market and the Fed be in so much disagreement as of yet. And it wouldn't even surprise me if we do see a rally into the close of the day today. And then like we've seen at the last FOMC meeting, the next day, tomorrow could just be very, very bloody. But this was overall bad. It did not show the Fed was slowing down to meet market expectations. Market expectations are, pricing in the Fed at least slowing down, and they're talking about going more aggressively. That's the Econ 101 version of all of this. Fed not slowing down, markets expecting the Fed to slow down a little bit, as you can see in the 10-year treasury yields. Now for UUP, this is the part that you should really be watching for the most. This is the US dollar. Now, the US dollar has been strengthening. It's not because the dollar is now more valuable all of a sudden. Technically, I guess it is, but it's because of world currencies devaluing comparatively to the US dollar, right? Because the US dollar gets its valuation based off of foreign exchange rates from other currencies. So when the US dollar is going up like this, well, that only happens during times of fear. Like you've seen during the COVID crash, right? Dollar plummeted and then it rallied straight to the upside only a couple days later, right? Because people were fearful about recession, depression, all of that. So people went out and bought the dollar because where are you going to hide out of any country in the world? What country is probably going to do the best when it comes down to a recession or depression? Probably going to be America, right? So you've seen that happening again. It hasn't been as explosive, not like these big candles, but you are breaking out to new highs for 2022. And in case you guys have not seen this, if you actually pull up the SPY, you're seeing a divergence here. So usually throughout the last 6 months, call it all throughout 2021, when UUP goes down, the stock market goes up. When UUP breaks out to new highs, well, the stock market is breaking out to new lows for the year. Take a look back here in May, right? UUP started to climb. As soon as it started to climb, the stock market started to come down, right? Once you actually seen UUP coming down, well, the stock market started to bounce. And now you see UUP, or just the US dollar, going up again, breaking out to new highs, whereas the stock market is trending to the upside as well. So I think the currency right here, the US dollar, is really showing this disconnect between the dollar and the S&P. And likely what's going to happen is the dollar's probably going to rip up to new highs. If I were to imagine Fed tightening, good for the dollar, getting more strength and stability to the dollar, bringing down the total money supply. is good for the US dollar. So I do think it will continue to go up, and then ultimately the stock market will eventually start to reflect that and will come down in a bigger way rather than not. Now it looks like on the S&P 500 as of right now, you're seeing a lot of call options coming through here in real time, and you are seeing so far about 3,500 orders total, worth about $403.82 million, and the positive order value is 89%. So it does look to be a bullish reaction initially, but do not be confused. This is not good. This is not good. I will repeat that. And what you're seeing actually down the option chains, if you look out to July 29th and really the end of July, you see a lot of bearish activity. So out of the total number of options that are on the July 29th expiration, just to point them out here, you could see that calls only make up 23.54% of the total option activity. The puts make up about 76.46% of option activity. We're pricing in the SPY, the S&P 500, to be in between 360 and 330 by the end of July. So I wouldn't get lost in the sauce here. Just because you're seeing this bullish reaction, nothing here looks bullish. Let's be clear, nothing in this report is bullish. So the markets can, be in a disagreement-like stance. They can disagree with the dollar, disagree with bond yields. But what we have seen is the 10-year treasury affects the stock market. The treasury either has to come up in a very big way, which would be very bad for the markets, or we get worse economic data and the Fed has to slow down, bond yields continue to come down, and we do head into recession in July. That would almost, like I said, be the better case scenario that could end up playing out. Now for tomorrow and for the economic data, we do get the balance of trade, which comes out at 8:30 in the morning, and the ADP employment change for June. The balance of trade will be very important. If we are showing signs of a recession and a larger trade deficit than what we are expecting of about $87.1 billion, that could actually be a slightly positive thing because maybe the Fed won't raise rates as aggressively. I think this whole, if the Fed won't raise rates as aggressively, it won't even matter until we see inflation coming down in a big way. If we see inflation starting to come down, specifically next week, once we get CPI data reported to us for the month of June, if that comes down in a big way, then it's possible the Fed does start to go slower. But until then, I think we're really up shit's creek, and there's not too much we can actually do about it but enjoy the ride back and forth. But it's not looking so good. So let me know down below in the comment section if you guys have any questions about any of this information. I will personally answer your question down there, so make sure that you guys go ahead and do that. Also, if you guys want free stock, link down below in the description. Not a bad time to start a new brokerage given the brokerages that are going bankrupt, like your Voyager, like your BlockFi. So get your free stocks, Webull, Moomoo, and Public down below in the description. Thank you guys for watching. Until next time, you guys take care.